Imagine investing in a logistics company, right? You think you totally understand their fundamental business model.
Yeah, you think you've got it all figured out.
Exactly. And then you find out that up to 66% of the code running its entire global network isn't even written by a human engineer.
Which is just wild.
It's written by artificial intelligence. So today we are tearing apart DoorDash's Q1 2026 earnings. And, I mean, if you think this is still just like that pandemic era food delivery app bringing you cold French fries.
Right, the 2020 version.
Yeah, that version. If you still think it's that, you are missing what might honestly be the single biggest shift in local commerce history.
It really is a phenomenal evolution. I mean, we're looking at a corporate landscape right now where platform economics, global logistics, and, AI are all just violently merging together.
Merging in real time.
Exactly, because evaluating a company used to be a pretty simple exercise, right? You just check the balance sheet, see if they beat consensus estimate.
Pass or fail.
Pass or fail. But now you have to evaluate this dynamic multivariable equation. A change in, say, a routing algorithm in Helsinki can literally dramatically alter the profit margins of a delivery happening in Chicago.
It's so interconnected, and that's why we're here. Welcome to this deep dive into DoorDash's Q1 2026 earnings call transcript.
Glad to be here.
So our mission today is to put on our Talk Tickers hats and deliver a tight, data-forward, and frankly, highly opinionated breakdown of these results, specifically for you, the retail investor.
Because the retail investor needs this context.
They really do. We are translating all that dense Wall Street jargon into actionable insights so you can understand exactly what is happening under the hood at DoorDash.
Which, like I said, is absolutely critical right now because retail investors often suffer from this massive anchoring bias.
Oh, 100%.
They anchor their perception of DoorDash to, 2020 or 2021.
Lockdowns.
Right, the era of lockdowns, the stimulus checks, that whole explosive, almost accidental growth phase in food delivery.
When everyone was just stuck at home.
Exactly. But the company reporting these Q1 2026 numbers today is fundamentally trying to rewrite the rules of local commerce on a completely global scale.
They are transforming into the ultimate operating system for local commerce.
Yeah.
And, the data from this quarter really proves it.
It really does.
But before we get to the flashy stuff like the AI coding and these grand visions of indexing the physical world, we have to look at how they handle some immediate brutal adversity.
The friction.
The friction, exactly. The headline numbers from CFO Robbie show a company navigating some really intense real-world problems. Let's start with literally the weather.
Yeah, the literal weather.
He mentioned that winter storms cause a 1% drag on year-over-year gross order value, or GOV growth.
And, on the surface, 1% might seem to a lot of people like a rounding error.
Just a tiny blip.
Right. But we have to translate that percentage into absolute dollars and physical logistics. When you are processing the sheer volume of transactions that DoorDash does globally,
it is massive.
It's staggering. A 1% drag represents millions and millions of dollars and a massive disruption to the physical network.
See, my initial assumption when I see a phrase like weather drag is that consumers just lose their appetite, or maybe their internet goes down or something.
A lot of people think that.
Right. But that doesn't actually make sense, does it? If it's snowing heavily outside, I'm significantly more likely to order soup from my couch than I am to trudge out to a restaurant.
Oh, absolutely. The demand curve actually spikes during severe weather. Consumers aggressively want the service.
They are tapping the app more.
Exactly. The failure point, that drag they're talking about, happens entirely on the supply side of the marketplace.
The drivers.
Yes. This is the physical limitation of relying on human beings navigating 3-ton vehicles out in the real world. When a blizzard hits the Northeast or, heavy storms flood the streets in California.
Which happened a lot this quarter.
It did. It becomes unsafe or just simply too arduous for the independent contractors, the dashers, to actually be out on the roads.
So wait, if consumer demand is spiking, right, but the dasher supply is just plummeting because of safety concerns, what does the software actually do in that moment?
It has to react.
Because the algorithm can't just keep accepting orders, right? Otherwise, you end up with 1 million angry customers waiting 4 hours for a cold pizza.
Exactly. The marketplace algorithm has to actively step in and throttle that demand to protect the integrity of the network.
How does it do that?
It deploys a variety of, dynamic friction points.
Yeah.
So first, the wait times shown in the app are artificially inflated to discourage casual ordering.
So it'll say 90 minutes instead of 30.
Right, which makes you second-guess ordering. Second, the delivery radiuses are drastically shrunk. So instead of being able to order from a restaurant 5 miles away...
Which I usually can do.
Yeah, normally. But in a storm, the app restricts you to maybe a 1-mile radius to keep the few active Dashers very close to their starting points.
Oh, yeah.
And finally, dynamic pricing kicks in. It raises fees to try and incentivize the Dashers who are willing to brave the weather while simultaneously pricing out the lower intent customers.
So that 1% drag is essentially the sound of the algorithm hitting the brakes to prevent a catastrophic failure of the whole logistics network.
That's exactly what it is.
It's fascinating because it highlights this inherent vulnerability of the business model. I mean, no matter how good your app is, you are still bound by the laws of physics and meteorology.
You can't code away a blizzard.
You really can't.
But, the way management navigates that friction is what really separates a mature, resilient company from just a startup.
Yeah.
Because the underlying demand metrics remained incredibly strong despite the algorithm artificially throttling sales in those key markets. However, the weather wasn't the only storm they faced in Q1. There was a purely financial headwind that hit them even harder.
Yes, the gas prices. This just jumped right off the transcript for me.
Neat.
The company took a $50 million hit in the first quarter just to fund a gas rewards program for their drivers.
A direct subsidy.
Right. And they're projecting another $50 million impact for Q2 because they actively decided to extend the program.
Yeah.
That is $100 million in the first half of the year directly subsidizing fuel costs for their fleet.
And any retail investor who's just scanning the financial press would see this surprise $100 million expense and immediately assume margin compression.
Right. Panic mode.
The instinct is to view this as bleeding cash just to keep the network on life support. Because if drivers can't afford gas, they stop driving. And the whole multi-billion-dollar platform grinds to a halt.
When I read that number, my talk ticker's alarm bells just went off. Subsidizing an independent contractor fleet's variable costs like gas feels like a really dangerous precedent.
It can be.
Because if fuel prices stay high forever, does DoorDash just become a proxy for the oil markets? Why shouldn't you, as an investor, view this as a massive bearish signal for their operating margins?
Well, you would view it as a bearish signal if management simply absorbed the blow and issued a profit warning.
Like, oops, sorry.
Right. A weak executive team takes that $100 million hit, they lower their full-year EBITDA guidance, and they tell investors, sorry, macroeconomic factors are just out of our control.
But Robbie and Unicom didn't lower the guidance.
He didn't. He maintained it. And the actual mechanism of how they absorbed that massive cost is a masterclass in dynamic capital allocation.
How so?
They didn't just print money or take on toxic debt to pay for the gas. Anaconda explicitly outlined how they hunted for offsets elsewhere in the sprawling DoorDash machinery.
Like finding loose change in the couch, but on a corporate scale.
Exactly. They took planned, non-urgent investments, perhaps, marketing spend in certain mature markets, or the rollout of peripheral app features.
Stuff that's nice to have, but not critical right now.
Right. And they deliberately pushed them from the first half of the year into the second half.
So they essentially delayed their own internal roadmap to free up the cash flow to keep the drivers happy today.
They triaged their capital. In the short term, keeping Dashers on the road, earning a living wage despite the fuel volatility, is the single most critical investment they could possibly make.
Because without them, there is no business.
Exactly. The ROI on a happy active fleet vastly outweighs the ROI of launching, say, a new ad campaign in February.
That makes total sense.
But delaying investments isn't enough on its own to save the margins. The ultimate proof that they are running a truly disciplined ship is found in their operating expense management.
Okay, I have that exact metric circled in red on the transcript. Management guided that their OPEX operating expenses is being held to roughly a 2% growth rate.
And you have to put that 2% into the broader macroeconomic context.
Right, because everything is more expensive now.
Everything. We are in an inflationary environment where software costs, server costs, corporate real estate, it's all rising. And DoorDash is actively scaling globally. They're integrating massive international acquisitions. And somehow, despite all that, they are holding their baseline operating expense growth to a mere 2%.
While simultaneously eating a $100 million gas subsidy.
Exactly. The math only works if they are discovering massive structural efficiencies internally.
Like trimming the fat.
They are stripping out waste at an unprecedented level. And if you can hold your fixed costs basically flat while your top line revenue continues to grow, you create an incredible amount of operating leverage.
With the profit margin widens.
Right. Every new dollar of revenue starts falling straight to the bottom line instead of getting eaten up by overhead.
Which begs the obvious question, though. You can be the most disciplined capital allocator in the world. You can hold OPEX to 2%, but you cannot simply cut your way to long-term prosperity.
No, you can't.
Eventually, the top-line demand has to accelerate to outpace those costs, right?
And that is exactly where the narrative of this earnings call flips from defensive management to really aggressive offense. Because the core user demand, the actual humans opening the app and spending their hard-earned money, is accelerating in ways that completely defy the broader retail slowdown we're seeing elsewhere.
Let's look at the underlying drivers of this Q1 performance then. Because the consumer metrics Robbie shared are just staggering.
They really are.
Monthly active users, or MAUs, hit an all-time high. And not just like a post-pandemic high, an all-time high.
Which a lot of analysts didn't think was possible.
Right. Order frequency is accelerating. And most importantly, it was a record quarter for their subscription products. Both DashPass in the US and Wolt Plus internationally saw their highest engagement and fastest member growth ever.
And we need to pause here because the subscription metric is the holy grail for a platform business.
It really is.
For a retail investor trying to value DoorDash, you absolutely have to separate the casual transactional user from the subscriber.
They are two different species of consumer.
Completely different. When a user upgrades to DashPass, their entire behavioral psychology undergoes a radical shift.
I can actually speak to this personally.
Oh, yeah?
Yeah, because before I had DashPass, every single time I went to order, like a burrito, I'd get to the checkout screen, I'd see a $4 delivery fee, a $3 service fee, and I'd immediately feel this surge of friction.
The sticker shock.
Exactly. I'd literally ask myself, am I really this lazy? Is this burrito actually worth an extra $7? And half the time, honestly, I just abandoned the cart.
Because the delivery fee acts as a psychological barrier. It frames the entire service as a luxury, like a splurge for a special occasion.
Right.
But the very moment you pay that flat monthly fee for DashPass, that friction just vanishes. You trigger the sunk cost fallacy.
Oh, absolutely.
Yeah.
I've already paid my $10 for the month, so in my head, I need to order as much as possible to ensure I'm, quote unquote, saving money on delivery fees.
Exactly. You stop viewing DoorDash as a luxury, and you start treating it as a baseline utility.
Like my water bill or electricity.
Yes. And the data bears this out perfectly. Order frequency skyrockets once a user subscribes. But the downstream effects of that increased frequency are what truly supercharge the whole business model.
Walk me through the unit economics of that. If I'm ordering 3 times a week instead of once, sure, DoorDash is collecting more service fees from me, but they also have to pay a dasher to make 3 separate trips.
Right.
So how does that compounding frequency actually improve their margins in the end?
It comes down to 2 things: delivery density and algorithmic learning.
Okay, density first.
When a specific neighborhood has a very high concentration of DashPass members ordering frequently, the geographic density of active orders in that zip code increases.
So there are just more orders happening closer together.
Yes, and the routing algorithm can now seamlessly batch those orders. So a dasher isn't driving from point A to point B for just one burrito anymore.
They're doing multiple drop-offs.
Exactly. They are picking up a burrito from restaurant A, they're grabbing a salad from restaurant B right next door, and they're delivering them to 2 houses on the exact same street.
Oh, wow.
The cost to serve per order drops dramatically, but the revenue per order remains stable.
So they're pocketing the difference. And what about the algorithmic learning part?
Well, a user ordering once a month gives the recommendation engine very little signal, right? It's hard to build a profile.
Right.
But a user ordering 3 times a week provides a massive data stream. The app quickly learns your dietary preferences, your exact price sensitivity, the specific times of day you usually want coffee versus a full meal.
It knows my habits better than I do.
It probably does. And because of that, the in-app real estate becomes hyper-personalized, which drives up conversion rates for the high-margin advertising business we'll discuss later.
Okay, so the subscription flywheel is spinning faster than ever. But managing that compounding complexity, the batching, the routing, the personalization across millions of users globally, that requires a technical infrastructure that is almost unfathomably large.
It's massive.
Which brings me to the statistics shared by CEO Tony Zhu that literally forced me to rewind the transcript.
I know exactly the one you're talking about.
He stated on the record that between half and 2/3 of DoorDash's code is now written by artificial intelligence.
It is a massive paradigm shift. Up to 66% of the underlying code base powering this entire global logistics behemoth is generated by machines.
When I first heard that, I'll admit my immediate cynical reaction was, great, they're going to fire half their software engineers to save money.
That's everyone's first thought.
Right, because if a machine is writing the code, you don't need the humans anymore, do you?
But that is a fundamental misunderstanding of how generative AI actually functions within a highly complex software environment. The human engineers aren't being replaced here. Their roles are being violently elevated.
I was trying to conceptualize this, and the best analogy I could come up with is like a high-end commercial kitchen.
Oh, okay. Let's hear it.
Usually, your senior executive chef is stuck doing a lot of the grueling, repetitive prep work, chopping 1,000 onions, reducing the basic stocks, peeling potatoes. It takes hours, and it keeps them away from actually designing the menu.
And in this scenario, the AI is the army of tireless sous chefs.
Exactly. These robotic sous chefs can dice 1,000 onions flawlessly in 5 seconds. They can whip up the foundational sauces instantly.
Right.
So the senior executive chef, the human software engineer, is no longer holding a knife to chop onions. They are standing at the pass, tasting the dishes, adjusting the seasoning, and directing the overarching strategy of the restaurant.
That is honestly the perfect way to understand it, because in software development, there is an immense amount of what they call boilerplate code.
Boilerplate.
Yeah, it's this repetitive structural syntax that connects databases, builds very basic user interfaces, and handles routine logic.
The boring stuff.
The totally boring stuff. It's the digital equivalent of chopping onions. It takes a lot of time to write, but it doesn't require deep, creative problem solving.
So the AI is generating the boilerplate, freeing up the human engineers to do what exactly?
To architect the system. To figure out how the routing algorithm should handle that flooded street in California in real time.
The hard problems.
Exactly. To design the incentive structures that balance Dasher pay with merchant fees. If your human engineers are suddenly 3 or 4 times more productive because AI is handling all the basic syntax, you don't reduce your headcount to save a few bucks.
That would be short-sighted.
Incredibly short-sighted. You keep the headcount steady and you use that unprecedented leverage to ship new revenue-generating features at light speed.
Which perfectly explains how they are holding their OpEx growth to 2%.
Exactly.
They aren't going out and hiring thousands of new engineers to build these new features. They're getting triple the output from their existing workforce.
Yes. But Tony Zhu offered a very sober caveat to this AI productivity boom. He pointed out that shipping code faster does not automatically translate into delivering better outcomes for the consumer.
Right. If your robotic sous chef cooks a perfectly executed dish, but it's a dish the customer didn't actually order, it doesn't matter how fast it was cooked.
The meal is still a failure.
It's a total failure.
So the bottleneck in the engineering pipeline has shifted. It used to be the sheer physical time required to write and test the code. Now the code generation is nearly instantaneous.
Because of the AI.
Right. So the new bottleneck is deciding what to build in the first place and ensuring the quality of the end-to-end user experience. The human element shifts entirely from execution to strategic decision-making.
Let's look at where they're actually deploying that strategic decision-making globally, because this earnings call made it very clear that analyzing DoorDash strictly through the lens of, like, the American suburbs is a massive blind spot.
Oh, it's a huge blind spot. The international portfolio is where some of the most aggressive growth and operational learning is happening right now.
Tony Yu highlighted that Deliveroo, one of their major European entities, is seeing its highest growth rates in 4 years.
4 years?
And Wolt, the Finnish delivery platform they acquired, is actively gaining market share across virtually every country it operates in.
The acceleration in Europe is so fascinating to me because the operational environment there is profoundly different from the United States.
In what way?
Retail investors often fail to appreciate how geography dictates unit economics in logistics.
I assume you mean the physical layout of the cities, right?
Right.
Like delivering a burger in Dallas, Texas, where you have 6-lane highways, sprawling suburban grids, massive parking lots everywhere. That is fundamentally different than delivering a pastry in central London or Prague.
They are entirely different sports. I mean, older European cities were designed centuries before the automobile was even invented.
Right, horse and buggy days.
Exactly. They feature tight medieval street grids, cobblestones, pedestrian-only zones, and basically a complete absence of parking.
It's a nightmare for cars.
You literally cannot run a delivery network in Amsterdam using 3-ton SUVs.
The routing algorithm would just send drivers into permanent traffic jams.
It would break instantly. Therefore, the logistics approach in Europe has to be hyper-localized. Deliveroo and Wolt built their entire models around scooters, electric bicycles, and even pedestrians.
So the delivery radiuses must be tiny.
Incredibly small. Maybe just a mile or two. But within that single mile, you might have 80 highly desirable restaurants and thousands of very dense apartments.
So DoorDash acquired these companies to buy their way into the European market, obviously. But you mentioned something on the call about a two-way street of innovation.
Yes.
They aren't just letting Wolt operate in a silo over there. They are extracting Wolt's specific hyperlocal routing expertise and porting it over to the U.S.
Think about dense American urban centers, places like New York City, San Francisco, or downtown Chicago.
Where parking is also a nightmare.
Right. These areas share more DNA with London than they do with suburban Dallas.
That's a great point.
DoorDash realized that the algorithms Wolt's developed to optimize bicycle routing through European alleys could be adapted to drastically improve Dasher efficiency in Manhattan. They are cross-pollinating their intellectual property.
And it flows the other direction too, doesn't it?
It does. The U.S. operation has years and years of experience managing massive retail catalogs.
Like pharmacies and big box stores.
Exactly. Sprawling grocery inventories. European platforms historically really struggled with large-scale non-restaurant retail. It's just harder to do.
Yeah.
So DoorDash is taking their American catalog management software and integrating it into Wolt to expand the European basket sizes.
It is a brilliant synergy in theory. But, implementing that cross-pollination exposes a massive, glaring inefficiency that analyst Eric Sheridan rightfully pressed them on during the Q&A portion.
Oh, yes. The infrastructure question.
Yes. This was the moment in the transcript where I was just waiting for someone to point out the elephant in the room.
It was inevitable.
If DoorDash owns the U.S. platform, Wolt in Europe and Deliveroo in the UK, aren't they currently paying to maintain and operate 3 entirely separate tech platforms?
They are, and it is a staggering duplication of infrastructure costs.
It sounds so wasteful.
CFO Robbie openly confirmed it. He said they are currently running 3 redundant tech stacks in parallel.
3 different server architectures.
3 different code bases. 3 separate engineering teams dealing with maintenance and security patches. Everything is multiplied by 3.
That sounds like an absolute nightmare for operating margins. If I'm a retail investor focused on cost control, hearing that a company is burning hundreds of millions of dollars to run redundant systems makes me want to hit the sell button immediately.
I totally understand that instinct.
Why shouldn't I view this as gross inefficiency?
Because of the magnitude of the replatforming effort that is currently underway, management is very well aware of the redundancy, and they are willingly absorbing that immense short-term financial burden to merge all 3 global brands onto a single, unified global tech stack.
Like rebuilding the engine while the plane is flying at 40,000 feet.
Exactly. And the reason you shouldn't hit the sell button is because of the long-term feature velocity this unlocks.
Okay, explain.
Consider the current workflow. Let's say DoorDash's AI team develops a brilliant new machine learning search bar. It anticipates what a user wants to order based on the weather outside.
Cool feature.
Right now, to roll that out globally, they have to code it for DoorDash, then completely rewrite it for Wolt's unique architecture, and then rewrite it again for Deliveroo.
That sounds exhausting.
They have to test it 3 times, QA it 3 times, deploy it 3 times.
It's literally tripling the cost of innovation.
But once this global replatforming is complete, which Robbie guided will be largely finished through 2026 and wrapping up in early 2027, they will achieve the ultimate engineering leverage.
They will only have to write that AI search feature once.
They ship the code once, and it instantly goes live for a user in Dallas, a user in London, and a user in Helsinki, all simultaneously.
The velocity of their product development will just skyrocket while their maintenance costs plummet.
Furthermore, they aren't just picking the DoorDash code base and forcing the Europeans to use it. They are conducting a massive audit of all 3 systems.
Taking the best pieces.
Exactly. Taking the best of breed microservices from each Wolt's routing, DoorDash's cataloging, and combining them into a vastly superior Frankenstein super platform.
Okay, so it is a painful drag on the P&L today, but it is the construction of an insurmountable competitive moat for tomorrow.
That's exactly how you have to view it.
Okay, that clarifies the infrastructure strategy. Short-term margin pain for a long-term structural advantage. Now, Before we transition into what they are actually projecting for the future, we need to translate a piece of Wall Street jargon that absolutely dominated this earnings call.
I know exactly what you're going to say.
Every analyst kept asking about the new verticals.
It is the buzzword that defines the next decade of this entire industry.
So when management talks about new verticals, they are referring to absolutely any transaction on the platform that does not involve a hot meal from a restaurant.
Correct.
We are talking about weekly groceries, convenience store runs for ibuprofen, pet food, alcohol delivery, and just general retail.
And the single most vital data point in this entire transcript is the adoption rate of those new verticals.
I have the number right here, and it is a paradigm breaker. 30% of DoorDash's monthly active users are now ordering non-restaurant items.
30%.
Nearly a third of their massive global user base has fundamentally changed their relationship with the app.
If you take away only one metric from our deep dive today, let it be that 30% figure. It validates the entire long-term thesis of the company.
Help me understand the unit economics here, though. Why is delivering a bag of dog food so much more important to the company's valuation than delivering a plate of sushi?
It comes down to basket size, margins, and the amortization of customer acquisition costs.
Okay, break that down.
Restaurant delivery is a notoriously brutal, low-margin business.
It's historically terrible.
It is. The average order value is relatively small, maybe $30 or $40 for a couple of meals. The restaurant itself operates on razor-thin margins, so they fight DoorDash on the commission fees.
Right.
And the cost to physically deliver that small order eats up a massive percentage of the total transaction value.
Plus, the food is degrading in quality by the minute. If the dasher hits traffic, the sushi gets warm, the fries get soggy.
The customer demands a refund.
And DoorDash eats the cost.
Exactly. Restaurant delivery is high stress and low margin. Yep. But consider a grocery order. The user is buying milk, produce, meat, cereal, and household supplies for the whole week. The basket size explodes from $40 to $150 or more.
And the bag of dog food doesn't get cold in traffic.
Exactly. The spoilage risk drops precipitously. Because the total transaction value is so much higher, the fixed cost of the dasher's time becomes a much smaller percentage of the overall order.
So the margin expands.
The absolute dollar margin generated by a grocery order absolutely dwarfs a restaurant order.
But there's also the customer acquisition angle, right?
This is the genius of the model. DoorDash spent the last decade bleeding billions of dollars in marketing and promotions.
All those promo codes we used to get.
Right, to acquire millions of users and win the restaurant delivery wars. That customer acquisition cost, the CAC, is already sunk. It's paid for.
It's in the past.
Now they have that user's credit card on file, they have the app on their home screen, and they have the DashPass subscription locked in.
So when that user taps the grocery tab instead of the restaurant tab, DoorDash didn't have to spend a single marketing dollar to acquire a new grocery customer.
Precisely. Every non-restaurant order placed by an existing user represents incredibly high-margin compounding revenue.
Because the hard work is done.
The infrastructure is built, the user is captured, and now they're simply expanding the share of wallet. The fact that 30% of users have crossed that behavioral chasm proves that DoorDash is successfully training society to view them as an essential utility for daily living, not just a weekend luxury.
Okay, so with consumer behavior shifting so dramatically, a unified global tech stack being forged, and AI acting as a massive productivity multiplier, what is management actually promising investors?
Let's get to the numbers.
Let's dive into the forward-looking financial guidance and the overarching strategic vision that CEO Tony Zhu laid out for the rest of the decade.
The guidance portion of the call was remarkably confident, especially considering the macroeconomic headwinds we discussed earlier.
CFO Robbie provided some very explicit targets. He guided that full year 2026 EBITDA margins are expected to be slightly higher than 2025.
And we should probably quickly define EBITDA for any newer investors listening today.
Good idea.
It stands for earnings before interest, taxes, depreciation, and amortization. It is essentially the cleanest proxy for the core cash-generating operational profitability of the business.
Stripping away all the accounting maneuvers and tax structures.
Exactly, just the pure operational cash.
So he is projecting roughly $200 million of EBITDA for the full year. But the critical nuance he added was the timeline.
The timing is key.
He explicitly noted that the second half of the year is expected to be significantly stronger than the first half, both in terms of absolute EBITDA dollars and the margin percentage.
And this perfectly reconciles with our earlier discussion about dynamic capital allocation.
With the gas subsidy.
Right. They purposefully pushed major investments, marketing pushes, and R&D expenditures out of Q1 and Q2 to absorb that $100 million driver gas subsidy.
So the first half of the year looks a bit depressed on the balance sheet because they are carrying that subsidy weight.
Correct. But they are projecting that by the third and fourth quarters, the underlying revenue growth driven by that compounding DashPass frequency and the surge in those high-margin grocery orders will accelerate so aggressively that it will completely overwhelm the delayed investments they pushed into the back half of the year.
The core operational leverage will really shine through.
It will.
And there was a specific milestone regarding those new verticals that management highlighted, a target that I think really changes the entire narrative around the company's valuation.
The profitability milestone.
Yes. They projected that the new vertical portfolio, specifically the massive grocery and retail segments, will become gross profit positive by the second half of the year.
And that is not just a financial milestone, it is a historical vindication.
How so?
The graveyard of Silicon Valley is absolutely littered with the corpses of companies that tried to solve on-demand grocery delivery and burned billions of dollars in the process.
Oh, like Webvan.
Think about Webvan in the dot-com era, or the massive, massive losses sustained by the early iterations of Instacart. Grocery delivery is historically an incinerator for capital.
Because it's so incredibly complex to pick and pack 50 different fragile items inside a chaotic, crowded supermarket.
Exactly. To reach a state of gross profit positivity means the fundamental unit economics have finally crossed the threshold into true sustainability.
It's finally working.
It means the revenue they generate from the consumer fees and the merchant commissions now structurally outweighs the cost of the Dasher's time, the payment processing, and the customer support.
Once a vertical becomes gross profit positive, it ceases to be this risky R&D experiment and becomes a durable engine for long-term cash flow.
That's the turning point.
Okay, so the financial foundation is solidifying. The spreadsheet logic checks out. But then the earnings call took a turn into the philosophical.
It got very deep.
Tony Zhu spent a significant amount of time detailing his vision for something he calls agentic commerce.
This was the most profound and, frankly, the most futuristic segment of the transcript by far.
Whenever a tech CEO in 2026 starts talking about AI agents or agentic commerce, my eyes instinctively roll.
Yeah, it's become such a buzzword.
My immediate assumption is that they're just going to slap a ChatGPT text box onto the DoorDash app. Like, instead of tapping a picture of taco, I can type, "I am craving something spicy," and a chatbot will reply, "How about tacos?"
Which adds almost no value.
Right. That feels like a cheap gimmick, not a trillion-dollar vision.
If that were the extent of the vision, you would be completely right to roll your eyes. A chatbot is merely a user interface layer. It is just a skin.
So what is he actually talking about?
What Tony Zhu is describing is infinitely deeper. He is outlining the construction of a proprietary, real-time digital catalog of the physical world.
Let's pull that apart. What exactly does a digital catalog of the physical world actually entail?
To understand the magnitude of this, you have to look at the dominant monopoly of the digital age, Google. Over the last 25 years, Google built a virtually perfect digital catalog of the digital world. They sent out web crawlers to index every website, every Wikipedia article, every image on a server.
So if you want to know something online, they have it.
Exactly. If you want to know the capital of France or the history of the Roman Empire, Google can instantly retrieve that digitized information.
But Google's omniscience basically stops at the threshold of the physical world.
Precisely. If I want to know exactly how many ripe, ready-to-eat avocados are sitting in the wooden bin at the independent corner bodega on 4th Street right this very second.
You can't Google that.
I cannot Google that. That data does not exist anywhere on the internet.
Because the bodega owner isn't running a real-time API connected to a cloud server.
Right. They are just writing inventory on a clipboard or maybe using a 20-year-old point-of-sale system that absolutely does not talk to the outside world.
So the physical world of local commerce is entirely opaque to traditional search engines. You cannot scrape the inventory of a local hardware store the way you scrape a blog post.
No, you can't. To digitize that physical inventory, you need a physical presence. You need a constant, relentless stream of real-world data points.
And that is exactly what DoorDash has. They have millions of human sensors The Dashers walking down the aisles of these stores every single hour of every single day.
Tony Xu essentially stated that DoorDash is undertaking the monumental task of annotating the physical world.
Annotating it. Wow.
Every time a Dasher scans a barcode to pick up an item, every time they mark an item as out of stock, every time a merchant updates their tablet, DoorDash is ingesting that data.
They are building a database that knows where every specific brand of cereal sits.
Yes. What sizes of a specific running shoe are currently on a local rack? And yes, even the relative ripeness of the produce based on turnover rates.
But that data has to be wildly messy, doesn't it? Local retail inventory management is notoriously terrible.
Well, it's a disaster.
Customer picks up a bottle of shampoo, decides they don't want it, and leaves it in the frozen food aisle. Items get stolen. Shipments are delayed.
The data is incredibly chaotic, and this is where their AI investments truly shine. They are deploying advanced machine learning models to build structure, probability, and cleanliness out of that chaotic local data.
Cleaning it up.
They are creating a repository of physical truth that is completely unique to them. They own the servers, and they own the proprietary data flowing into them.
How does this proprietary data moat tie back into the concept of agentic commerce then?
Well, an artificial intelligence agent is only as intelligent and useful as the data it actually has access to.
Right.
Let's imagine Apple or Meta decides to build the ultimate AI shopping assistant integrated into their smart glasses.
Sure.
The assistant might be brilliant at conversing with you, but if it doesn't actually know what inventory is physically located within a 2-mile radius of your current location, it cannot fulfill your request.
Can only point you to an Amazon link and tell you to wait 2 days for shipping.
Exactly. But DoorDash's vision is to control the underlying physical database.
The actual inventory.
Right. So when you tell your DoorDash AI agent, I have a headache, I need ibuprofen, and I also want a specific brand of organic electrolyte water, DoorDash isn't making a probabilistic guess based on internet scraping.
It knows.
Their database knows that the pharmacy 3 blocks away has the ibuprofen, and the boutique grocer next to it has the water.
And more importantly, they have the logistical fleet to batch those 2 items together and put them in your hands in 25 minutes.
The AI agent isn't just a search engine, it is a fulfillment engine.
That is a staggering competitive moat that neither Google, nor Apple, nor Meta can replicate without spending tens of billions of dollars to build their own physical logistics network from scratch.
Yeah, which they aren't going to do.
But, to realize that utopian vision of agentic commerce, especially in highly subjective categories like grocery, the actual physical fulfillment has to be flawless.
It has to be perfect.
You can't have an AI promise me the ingredients for a dinner party and then have the Dasher show up with half the items missing.
Yeah.
And this is where I actually developed a lot of respect for management on this call.
Their transparency.
Yes, they were brutally honest about their current shortcomings.
Tony Xu did not try to spin the current state of their grocery product at all.
Not at all.
Yeah.
He bluntly admitted that they have miles to go before the online grocery delivery experience can even match, let alone beat, the offline experience of just driving to the store and doing it yourself.
He literally rhetorically asked the analysts, why is the grocery delivery industry not significantly larger than the restaurant delivery industry?
Because the total addressable market for groceries is massively larger than restaurants.
Massively.
And his answer was refreshingly critical of his own company. He said, because the online delivery experience is simply not yet good enough.
It is a profound admission of the friction inherent in the model. Think about your own behavior in a grocery store. You go to buy a specific brand of whole milk. The shelf is empty. Within a fraction of a second, your human brain processes your personal preferences, your dietary restrictions, and your price sensitivity, and you just reach for the 2% milk of a different brand.
It's a seamless calculation.
Completely seamless. You don't abandon your entire shopping cart because one brand of milk is out of stock.
But in the app, the out-of-stock scenario creates this cascading chain of digital friction.
It does.
The Dasher gets to the empty shelf. They have to text you through the app. You might be busy and not see the notification. You have to manually review and approve a substitute. Or, if the timer runs out, the item just gets refunded and dropped from the order entirely.
And now your recipe for dinner is completely ruined because you are missing the foundational ingredient.
And I am furious with DoorDash, even though it was a supermarket's inventory issue.
Exactly. So Tony specifically highlighted the goal of perfect quality, meaning the customer receives exactly the items they ordered with zero substitutions, zero out of stocks, and zero agonizing text exchanges with the Dasher.
But how do you achieve perfect quality when you don't actually control the chaotic supermarket floor?
You have to fundamentally change the architecture of fulfillment.
How?
This is where DoorDash is heavily investing in their DashMart services and white label fulfillment software. They're moving away from simply sending gig workers into crowded, consumer-facing grocery aisles.
Oh, because it's too slow.
Right. Instead, they're partnering directly with massive grocers to build dedicated inventory management systems.
Are you talking about dark stores?
Dark stores or localized micro-fulfillment centers attached to the back of existing supermarkets.
Oh, okay.
These spaces are optimized strictly for algorithmic picking, not for human foot traffic. The inventory counts in a micro-fulfillment center are nearly 100% accurate because humans aren't in there moving items around randomly.
So by controlling the inventory environment, they eliminate the out-of-stock friction at the source.
That's a goal.
You know, there was an interesting moment during the Q&A where an analyst tried to poke a hole in the profitability of this whole grocery strategy because DoorDash's advertising business, where brands pay to have their soda or chips appear at the top of the search results, is currently booming.
Yeah,
right?
the ad revenue is hitting record highs. It's a massive cash generator for them.
So the analyst basically asked, are you just using the massive profits from the ad business to subsidize the structural losses of the grocery delivery business, making the whole thing look profitable on paper?
It's a very sharp question because a lot of platforms play that exact shell game.
They use high-margin ads to hide a bleeding core product.
Exactly. They masks the rot.
But Tony Xu explicitly rejected that premise.
Yeah.
He stated emphatically that they refuse to rely on any unnatural sources of revenue, like advertising, to subsidize a fundamentally flawed grocery operation.
He was very clear on that.
They are demanding that the core unit economics of picking, packing, and delivering the groceries become profitable strictly on their own operational merits. The ad revenue is just the cherry on top. It cannot be the foundation.
And as an investor, that is the exact philosophy you want driving your capital.
Absolutely.
You do not want a business built on opaque cross-subsidies that mask an underlying rot. You want the core logistical engine to generate cash on its own.
Okay, let's zoom out and synthesize all of this. We are looking at a company that is willingly absorbing massive, unexpected fuel subsidies without breaking their strict 2% operating expense targets.
Check.
They are paying down massive, short-term infrastructure debts to unify a global tech stack across 3 continents.
Sure.
They are utilizing AI to dramatically increase engineering leverage. They are generating record consumer demand through subscriptions, dominating international markets, and aiming for total local commerce dominance by building a proprietary digital catalog of the physical world.
It's a lot.
It is a lot. So let's move to our final verdict.
Yeah.
For you, the retail investor listening right now, what is the bottom line?
If we put our Talk Tickers hats firmly on and evaluate all the data, the long-term strategy, and the management discipline, I have to take a firmly bullish stance on DoorDash based on this Q1 2026 transcript.
Lay out the overarching case. Why are you so confident in the face of all this macroeconomic uncertainty?
Because they are proving definitively and mathematically that they have evolved far beyond their origins as a simple food delivery tool.
They really have.
They are entrenching themselves as the essential, inescapable operating system for local commerce. Consider the sheer magnitude of the stress tests they passed in this single quarter.
It was a gauntlet.
It was. They absorbed the costs of running 3 entirely separate global tech stacks simultaneously. They absorbed a $100 million driver gas subsidy. They battled severe winter weather disruptions.
Any one of those could derail a company.
A weaker, less disciplined company would have crumbled under those cascading financial pressures and issued massive profit warnings. But DoorDash absorbed it all, held operating expenses to a 2% growth rate, and still guided for overall margin expansion and gross profit positivity in their most difficult new verticals.
That demonstrates an underlying business strength and operational elasticity that is incredibly rare in the tech sector.
Very rare.
And the cash they are generating from that core efficiency is funding their own moonshots. We haven't even deeply discussed the R&D they are quietly financing, specifically their DOT, autonomous vehicle platform.
Right. Analyst Michael Morton brought up DOT during the Q&A, and it is a critical piece of the long-term margin puzzle.
Whenever I hear autonomous delivery, I have to admit, I just picture those little cooler-sized robots awkwardly rolling down sidewalks and getting stuck on curbs. It always feels like a PR stunt, not a financial strategy.
And Robbie explained that DOT is not a novelty project. It is a fundamental manufacturing scale play aimed at driving the cost to serve down to absolute rock bottom.
Make the delivery practically free.
Exactly. You cannot optimize local delivery margins if you are relying on a human being driving a gas-powered 2-ton vehicle to deliver a single burrito. It is thermodynamically and financially inefficient.
It's overkill.
DOT is about building customized autonomous form factors specifically designed for the actual physics of local delivery.
Tony Zhu used an incredible analogy to describe their approach to autonomous vehicles. He said building a prototype robot is like shooting a three-pointer.
I loved this analogy.
Right. He said Tony Zhu, can physically shoot a basketball from the three-point line, and Steph Curry can shoot a three-pointer. They're technically doing the exact same motion.
On paper, it's the same thing.
But one is a weekend hobbyist, and the other is the greatest shooter in the history of the sport.
And it perfectly encapsulates the autonomous vehicle industry. It is relatively easy for a startup to build a shiny prototype robot that can navigate a perfectly sunny, flat, controlled suburban sidewalk for a promotional YouTube video.
That is Tony Zhu shooting a three-pointer.
Exactly. It is exponentially harder, almost impossibly hard, to build a fleet of thousands of autonomous vehicles that are battle-tested, meaning they can operate safely and reliably at scale in blizzards, navigate chaotic urban traffic, handle complex regulatory environments, and seamlessly interface with angry merchants.
That is the Steph Curry level of execution.
And DoorDash isn't rushing to post PR videos. They are quietly, methodically doing the grueling, unglamorous work, solving the hardware supply chains, refining the remote operation centers, navigating the municipal regulatory hurdles to build the Steph Curry of autonomous delivery networks.
And crucially, because their core business is generating so much free cash flow efficiency right now, they can afford to fund this massive multi-year R&D project entirely internally.
They don't have to go back to the public markets, issue more stock, dilute their shareholders, or take on punishing debt to finance their autonomous future.
That is the definition of a structurally bullish setup. A highly profitable core business funding a transformative future monopoly.
It really is.
Okay, that is the macro 10-year bullish thesis. But we promise actionable insights on talk tickers. For the listener right now who is holding this stock in their portfolio or maybe actively considering starting a position on Monday morning, what is the single most important thing they should monitor in the next quarter's earnings report?
You need to completely retrain your focus. Stop analyzing DoorDash solely through the lens of restaurant delivery metrics.
Say that again, because that goes against everything the financial media talks about.
I know it does. But the restaurant delivery wars of the early 2020s are functionally over, and DoorDash won the volume game in the United States. Tracking marginal changes in burrito deliveries will not tell you where the stock price is going.
So what's the number?
The actionable number to watch, the metric that will dictate the future multiple and valuation of this company, is that 30% figure we unpacked earlier. You must track the percentage of monthly active users who are ordering outside of restaurants.
Management has explicitly stated that their ultimate goal is to drive that number to 100%. They want every single human being who uses the app to buy a pizza on Friday night to also instinctively use the app to buy their weekly groceries, their dog food, their cold medicine, and their hardware supplies.
And as you monitor that metric climbing from 30% to 40% to 50% over the coming years, you will see the unit economics and the profitability of the entire platform compound dramatically.
Because the expensive infrastructure, the app development, the cloud servers, the Dasher acquisition is already paid for by the restaurant business.
Exactly. The customer acquisition cost for the grocery side is effectively zero. Therefore, every incremental non-restaurant order with its massive basket size acts as high-margin gravy flowing directly to the bottom line.
Watch that 30% metric religiously.
As long as it keeps growing quarter over quarter, the bullish thesis remains perfectly intact.
All right, it is time to wrap up this incredibly deep dive. To briefly summarize our core takeaways today, DoorDash is executing cleanly and accelerating consumer demand despite facing literal and macroeconomic weather headwinds. They are ruthlessly managing their operational costs, absorbing massive shocks like the $100 million gas subsidy without missing their margin targets. They are utilizing AI to fundamentally change their engineering leverage. And they are investing heavily in unifying a global tech architecture that will drastically lower their future cost of innovation.
Setting themselves up for the future.
They are no longer just delivering food. They are attempting to systematically digitize the physical inventory of the world.
It is a breathtakingly massive ambition. But, the data from this Q1 transcript really suggests they actually possess the rigorous operational discipline necessary to pull it off.
Which leaves us with a final provocative thought for you to mull over as an investor. We spent a lot of time discussing CEO Tony Zhu's philosophical vision of cataloging the physical world.
The agentic commerce idea.
Right. Knowing exactly what sits on the shelves of millions of local stores, down to the ripeness of the fruit, the size of the shoe, and the exact inventory of the corner bodega, that is data that simply does not exist anywhere on the internet right now. Google doesn't have it. Apple doesn't have it.
No one has it.
So if DoorDash successfully builds this proprietary digital catalog, and they eventually pair that omniscience with their DOT autonomous delivery network, do they eventually transcend the concept of delivery altogether?
Expand on that. What do you mean by transcend delivery?
Think about the fundamental utility of the internet. If DoorDash knows exactly where every physical object in your city is located in real time, and they have sophisticated AI agents capable of processing your complex, multivariable queries, could DoorDash become a primary search engine for the physical world?
Wow.
A search engine that is actually more accurate, more powerful, and more immediately useful than Google for local commerce. If you want to find a real, tangible object right now, you wouldn't open a web browser. You'd ask the DoorDash agent.
Because Google can only give you a hyperlink to a website that might have the item in stock for shipping next week. DoorDash can locate the actual physical object within a 2-mile radius and place it directly into your hands in 20 minutes.
That is a terrifying prospect for traditional search monopolies.
It is a complete paradigm shift in how humans interact with local economies.
Think about that next time you open the app just to order a late-night pizza. You might be interacting with the foundational operating system of physical reality.
Incredible.
Thanks for joining us on this deep dive. Keep your eyes on the data, watch those new vertical metrics, and we'll see you next time on Talk Tickers.